Today we're taking a look at an alternate version of exercise 5-3 from page 256 of the textbook, chapter 5, Reporting and Analyzing Inventories. So this problem here is on inventory costing methods. Let's take a look at the data. It says Laker Company reported the following January purchases and sales data for its only product. Here we're given a list of dates. They started on January the 4th. They had beginning inventory of 200 units. Those units cost them $7 each, and altogether the value of that beginning inventory was $1,400. Now on January the 10th, they sold some goods. They sold 160 units. The sale price is $18 a piece. January the 20th, they purchased some more goods, 150 units. This time the price went down actually. It went down by 20 cents, so those goods only cost them $6.80 a piece, altogether $1,020. Next, in January on the 25th, they sold 100 units. They sold them at the retail price of $18. And then finally on January the 30th, they purchased 160 more units. They purchased those at even a lower price. Prices are going down as we see here. They purchased those at $5.90 a piece. Altogether, they paid $944 for the units. So it says Laker uses a periodic inventory system. And we covered that in our Learn Smart module. And here we're asked to determine the cost assigned to cost of goods sold using the specific identification, the weighted average, the FIFO, and the LIFO method. In reality, we're going to do two things. We're going to find out what is the cost of goods sold and what is also the value of the ending inventory for the company. So before we go into that, let's just recap things kind of in a T account format. The book doesn't do this, but I think it's really helpful. Let's first think about the T account for the inventory, the units of inventory that Laker has. There are three real major parts to this T account that we have to acquaint ourselves with. The first is an item that gives us the total units that they had available for sale. On the left-hand side, we'll find that. On the right-hand side, we'll find all of the units that were sold, and then the units that were available to sell minus the units that were actually sold. Well, of course, that's going to equal their ending units. So for Laker, they had altogether how many units that were available to sell during the month of January? Well, 200 plus 150 plus 160. Oh, they had 510 units. The term we give for those units are the units available for sale. Pretty common sense. Now, we know that throughout the month of January, they sold 160 units and another 100 units. So how many units did they sell altogether? They sold 260 units. So the units sold were 260. Well, if they started with 510 units and they sold 260, how many units have to be left in ending inventory? Well, 510 minus 260, ending inventory is 250 units. Let's also look at these T accounts now not in terms of units, but in terms of the cost of these units. So let's put up another T account, inventory cost. So what was the cost they paid for all 510 of those units? Well, we have that total. We totaled that at the very beginning. That total was $3,364. Remember, that was just all the different purchases they made times the cost per unit in each of those purchases, gave us the total cost of all the purchases. We add all those up, and that's just the total cost of all the goods that Laker had available to sell throughout the month of January. We simply call that term there the cost of goods available for sale. Now, on the left-hand side, we list the cost of goods available for sale. On the right-hand side, we list the cost of the goods that were sold. Remember, we had units sold in unit amounts. Now we're going to list that in dollar amounts. If we take the cost of goods available for sale minus the cost of goods sold, that should equal the ending value of the company's inventory, shouldn't it? Let's put some numbers to this. So for the inventory cost, their cost of goods available for sale, the cost of all the purchases they made plus what they started off in the month, that was $3,364. Our task now is going to be to decide, well, what was the value of all the stuff that was sold? we could determine also what the value of the stuff that was at the end as well, what their ending inventory was. Once we know either the ending inventory or the cost of goods sold, we simply subtract that number out of cost of goods available for sale, and what's left over should be the remaining item. So we could take 3364, subtract out whatever value we come up for ending inventory, and what's left over should be the value of cost of goods sold. It's really important to note here that the cost of goods available for sale is going to equal together the cost of goods sold and the ending inventory. That's the exact same as we saw back in the units. The units available for sale, well, that's going to equal the number of ending units plus the units that were sold. So applying these concepts, let's start working the problem to determine under the specific identification method, what were Laker's cost of goods available for sale, ending inventory, and cost of goods sold. So here we have the exact same data we saw on the previous page, and when you do this in Connect is going to ask you to fill out a chart very similar to this chart that I have on the slide. The first thing we're going to see is that we need to complete how many units were sold, and we know already they sold altogether 260 units. Well, how many units did they have available to sell? They had 510 units. So how many units must be left in Laker's ending inventory? Well, they must have 250 units left in ending inventory. So just as we did before, units available for sale, how many were those? 510. Hopefully you said that. Ending units, well, they ended with 250. So then what had to have been the missing number or the units sold? 510 minus 250 is 260. Now let's look at the value that made up those individual ending units and units sold. It says for the specific identification method, ending inventory consisted of the 250 units, we had that, where 160 were from the January the 30th purchase, 70 are from the January the 20th purchase, and 20 are from the beginning inventory. So they sold some items, but they specifically sold certain items. They didn't sell any from the January the 30th. Out of the 150 they had available to sell from the January 20th purchase, they sold 70. Out of the beginning inventory of 200, how many did they sell? Well, they have 20 left, so they must have sold 180. So we know that all 160 are left, the 70 are left from the January the 20th purchase, and the 20 are left from the beginning inventory. So to figure out how many units were sold out of each layer of inventory, we'll simply take the 200 they had minus the 20 that were left, and we know that they must have sold 180 units from their beginning inventory. From the units they purchased on January the 20th, they had 70 left. That came right from our data. Therefore, 150 minus 70 means that they must have sold 80 of them. Did they sell any of the 160? No, they had all of those indeed. So now we know how the units are laid out, specifically what unit layers make up the 260 that were sold and what unit layers make up the 250 that remain. Now let's move into the cost to try to determine what were the cost of goods available for sale, what were the cost of goods sold, and what is the company's ending inventory. So as far as inventory cost, the cost of goods available for sale, that's the same as what we showed on the very first slide for the problem. That's $3,364. Remember, that's just the dollar amount they paid for every single item that they had available to sell to their customers during the period. So all 510 units that they had available to sell, those all cost them $3,364. Now we can determine what is the cost of goods sold for the company or the ending inventory. We know whichever one we take, We subtract that from the cost of goods available for sale, and that gives us the answer to whatever was left. The book likes to start with cost of goods sold, so let's calculate this first. They sold, out of the 200 units that cost them $7 each, they sold 180 of those. So they got rid of altogether 180 units that cost them $7, so the cost of goods for those units was $1,260. They sold 80 of the units from the January the 20th purchase. Those, remember, cost them $6.80, so the cost of those units that were sold was $544. And remember, they did not sell whatsoever any of the units from January the 30th, so they have no cost of goods sold for those items. So now we simply total for cost of goods sold the cost of the 180 that were sold at $7, the cost of the 80 sold at $6.80, and our cost of goods sold is $1,804. Where does that go on our T account? Well, those are goods that are coming off of the inventory list, so $1,804 will come off. Now, right here and there, then we have to know automatically what is the value of ending inventory, don't we? Because if we had total goods available to sell of $3,364, we got rid of or sold $1,804 of them, then we know that $1,560 has to be the value of our ending inventory. On the chart, let's go ahead and itemize what were the components that make up that total ending value of $1,560 from each of the three layers. So we do some math again. We have 20 units left from the beginning. Those cost $7 each, so those are worth $140, right? The January the 20th, we got 70 left. We paid $680 for those, or altogether $476. The 160, haven't touched those at all, so that hasn't changed. That should be $944 for the 160 at $590. We simply total those together, and what do you think ending inventory is going to come up to as far as a total? Well, we already calculated. That has to come up to $1,560, and it indeed does. So just remember the specific identification method. You get rid of specific units. You take those specific units out of the units that were available, and you calculate the value for what is left. Let's move on now to the next method, the weighted average method. It's the exact same data that we had before. Under the average cost method, we're going to calculate things by taking the cost of goods available for sale. Remember what number that is? The cost of all of the goods that were available to sell during the period, $3,364. We're going to divide that by the number of units that we had available for sale. What were the total units that were available to sell? That was the 510 units. So simply take the 3,364, how much we paid for everything, divided by 510, all of the units that we have, and we come up with what? An average cost per unit. In this case, each of those units costs us on average $6.60. It rounds out a little bit further, $6.59.6, but we'll say about $6.60 is pretty close. So now that we know that every unit cost us essentially $6.60, we can real quickly determine what was our value of ending inventory and what was the value of cost of goods sold, can't we? Well, the cost of goods sold, we know that we sold 260 units. Remember, we sold on January the 10th, 160, on January the 25th, another 100. So altogether, we sold 260. What was the value that we need to take out of our inventory for those units that were sold? Well, it's the 260 times their average cost of $6.59.6, about $6.60. Or altogether, the cost of goods sold was $1,714.96. Ending inventory, we can calculate that precisely, or we can also just subtract cost of goods sold out of cost of goods available for sale. I'll show you that in just a second, but we know that there were 250 left. That times the 6.596 means the ending inventory had to be 1649. There's a difference because of some rounding issues, but that's pert near. Let's just recap about units. Remember, we had the 510 units that were available to sell during the period. We sold 260, so there's 250 that are left. All we're doing now is valuing the cost of goods available for sale, the cost of goods sold, and the value of ending inventory. So, cost of goods available for sale, what was it, gang? Well, it's the same number we looked in the specific method, the 3364. That's the cost of all the goods that were available to sell. From here, we can subtract out cost of goods sold or ending inventory, whichever you want to do first is fine. You're going to get the other one as the product. Let's subtract out the 1714.96, that was cost of goods sold. So if we had available to sale of 3364, we take out 1714.96. What's got to be left is the value of the ending inventory at 1649. Okay? So the weighted average method, pretty similar. Remember the three key components: cost of goods available for sale, that's the same for every single problem. Cost of goods sold and ending inventory. The sum of ending inventory plus cost of goods sold, what is that going to equal? Cost of goods available for sale. 1649 plus 1714.96 equals, we were off a little bit because of the rounding error, 3364. Let's move on to the next method. Let's take a look at the periodic FIFO method. Now the periodic FIFO method, we have the exact same data we've been working with, and we're just saying, let's revalue this inventory not on the specific method, not on the average cost method, but on this other alternate method of valuing inventory, the first in, first out method, which is the FIFO method. It says the first units in are the first ones that we're getting rid of, okay? And really, we're going to specify that more as the cost. The first cost in are the first costs that are going out, or the first costs that are getting expensed out. So it's the exact same data that we started off with. We had 510 units available to sell. Those 510 units cost us $33.64. We sold 260 units, which means we have left how many units? This is getting old, right? 250 are the units that we have left. Putting up our T account for units, we see the units that we had, less the units that were sold, equal the ending units. But notice also you could take units available for sale minus ending units and also get units that were sold. Works out the same. The sum of these two equals the sum of this. What were the components of the ending units and what were the components of the units sold? Well, in this problem here, we know that we sold 260 and we're getting rid of the first cost first. So the first ones in are the first ones out. We have three layers of cost to choose from: the beginning inventory of 200 units, the January the 20th purchase of 150, and the January 30th purchase of 160. Which ones did we get first? Well, the beginning inventory is what we had first. So those are the first costs that we're going to get rid of. We're looking to assign 260 units of cost, but there were only 200 available, so we're going to use up all 200 of those. But have we assigned all of the cost? No, because we sold 260, we're taking out 200, so how many are we still looking for then? Well, we're still looking for another 60. So we'll have to take them out of the next available layer under the first in, first out method, which would be the January the 20th layer. And now we've accounted for all 260 units. Notice we did not get into whatsoever the units that were purchased on January the 30th. We didn't need to. We used up all the beginning stuff, and we used up 60 of the 150 that we had from the January the 20th purchase. Okay? So then, with that, we can determine what's left, right? Because we started with 150, took out 60, must mean there's 90 left. Notice we didn't touch any of the January the 30th, so all of those are left. So now we see that, our ending inventory is really made up of two layers. It's made up of some stuff that we purchased at $6.80, 90 of those units, and it's also made up of stuff that we purchased at $5.90, 160 of those units. Well, let's put a value to these ending inventory or to the cost of goods sold. Take a look at the T account for the cost. What was our cost of goods available for sale first? It hasn't changed at all, $33.64. Next, we can determine one of the two things, either the value of ending inventory or cost of goods sold. The book likes to do the cost of goods sold first, so let's go that way. We'll value what was sent out to customers, what was expensed out to customers. The 200 at $7 a piece, $1,400. The 60 at $6.80 a piece, $408. We didn't use up to customers any of the items from the January the 30th purchase, so our cost of all the goods that were sent to the customer, those 260 units using the first in, first out method, totals up $1,808. Now notice right here, we can automatically calculate what? We can automatically calculate what our ending inventory is. Simply take $33.64 minus $1,808, and we know that the ending inventory has to be $1,556, right? Let's go ahead and just detail out, though, what were the specific cost layers that make up this ending inventory of $1,556. So we know we have nothing left from what we started with. The 90 that are left out of the January the 20th purchase, $6.80 a piece. Oh, there's $612 left for those. The 160 we never touched, so that has its full value still of the $944. So simply take $612 plus $944, and our ending inventory is indeed $1,556. Okay, let's move on to the last one. It's the periodic LIFO method. Under the periodic LIFO method, we're going to say out of these layers that we have, the last ones that we purchased are going to be the first ones that are going to be expensed out to customers. So under FIFO, we started with the 200. Where are we starting with under LIFO? We're starting with the January 30th purchase of 160. So let's get our data going here. How many units do we have all available? Well, we had 510 that were available. We sold 260. That means that 250 were left. Putting that down into our familiar T account for inventory units, we see that the 510 equals the 250 plus the 260. Units available equal units sold plus what's left over. Looking at the components of what was left over and the components of what was sold using the LIFO method. So we sold 260. Where are we going to start taking those 260 out? From what we started with or from the very last purchase on January the 30th? Well, the last in, first out method says the last ones you purchased are the first ones you're costing out. So we're definitely going to start with the January 30th purchase. Out of the 260 that we sold, 160 was available here. So we're going to get rid of all those, right? How many more are we still looking to account for? Well, we sold 260, we've accounted for 160, we need another 100. We'll take those out of the January 20th layer, and now we've accounted for all the items that were sold. So we know the 260 that were sold, what they comprise of. 100 from the January 20th layer, 160 from the January 30th layer. How about what's left? Well, we simply subtract them out, what was sold from what we started with. 100 out of 150 leaves 50 left for that layer. We used up all the January 30th, but we didn't touch any of the beginning stuff, so our ending 250 comprised of these two layers, the stuff we started with plus the 50 left over from the January 20th purchase. Now let's value these. So inventory cost, remember cost of goods available for sale starts out $33.64. Now we can either calculate ending inventory or cost of goods sold. The book likes to use cost of goods sold, so let's just simply value things across. 0 times 7, 0. 100 times 680 is 680. 160 times 590 is 944. Add these together, and we have our cost of goods sold. Here, cost of goods sold was $16.24. Can we automatically determine what ending inventory was? Yeah, you bet we can. We can take $33.64 minus $16.24. We know that ending inventory had to have been $17.40. What were the specific layers of cost components in that ending inventory, well, we have to do some math for that. Take the 200 times the $7, $1,400. For the 50 that are left are 680, that's at 340. Add them together, and the ending inventory is indeed 1740. So that's a quick look at how to value inventory under these different 4 methods.